Oil prices went up after the US and Iran stopped talking, and this was more about what the market thought would happen than about an immediate drop in oil available. Crude oil went up by over 2.67%. While that percentage isn't huge, oil is essential for so many things: getting around, making things, food costs, and generally how quickly prices are rising, inflation. For months, the market had been anticipating some sort of progress with the US and Iran. This wasn't because of any actual deals, but because of signs that they were talking to each other, even if indirectly. Financial markets often price things based on what people expect to happen, before it's confirmed. If Iran had started selling more oil worldwide, there would have been more supply, and generally, more supply means lower prices. Because of this, some in the market had cut back on bets that oil prices would stay high and change their strategies. When the talks fell apart, those expectations flipped. The extra oil from Iran wasn't going to happen, and so prices were adjusted to show a tighter than expected supply. Oil prices aren't just about how much is being used right now and how much is available. They're about what people think will be available in the future. Iran could supply a lot of oil, but it's currently restricted because of sanctions and issues in the region. And if those restrictions changed, millions more barrels could go on the market each day. Even relatively small changes in supply, 1 or 2 million barrels a day, can have a big effect on prices globally. So the possibility of Iran selling more was a key factor in everyone's calculations. With that possibility gone, at least for now, the market started to think of future supply as being less flexible. Oil markets also react strongly to uncertainty. Prices can climb even if there's currently enough oil, if people are worried about problems happening later. Countries and companies will often get oil ahead of time, building up stores or agreeing to contracts to avoid running out, and this adds a risk premium to the price. The end of the negotiations didn't immediately remove oil from the market, but it did increase worries about what the supply situation would be in the future, and that worry showed up in the price. At the same time, there isn't a huge amount of spare oil production capacity right now. Decisions by OPEC+, slower growth in US shale oil production, and strong demand from the biggest economies mean there's not a lot of room for things to go wrong. The system is working, but it's not very resilient. In this situation, Iran being able to sell more oil would have given the system more flexibility. Without that, any problems in the Middle East matter more. The market's reaction also shows more general worries about how stable the Middle East is. Because of its location, Iran is central to energy security. Any sign of increased trouble can make people think there's more risk, including the possibility of oil production or transport being interrupted. Markets factor in these risks to the price before any actual interruption. Just the possibility of things getting worse is often enough to influence prices. When oil prices change, this affects the wider economy. Higher energy costs increase the cost of moving things and making things, which then increases the price of goods and food. This can push up inflation and affect what central banks do. Central banks are carefully watching energy prices as continuing increases can make it harder to control inflation. Rising oil prices might mean delaying lowering interest rates or changing plans for future interest rate policy. The recent price increase also shows a change in how the market is positioned. When prices jump quickly after news about international politics, it usually means previous expectations didn't match the new information. Traders and big investors quickly change their plans, and prices change sharply as a result. The price of oil has gone up because people have revised their estimates. It's now considered less likely that Iran will add to supply, and the chance of political trouble in the Middle East has gone up. This means less oil is expected to be available, and the risk premium is increasing the price. Big players in the energy market, governments, companies, and financial institutions, all have ways of managing their risk, using things like hedging and long-term contracts. When uncertainty rises, their combined actions can make price swings even bigger. Simple explanations in the news usually reduce these events to a simple cause and effect. But underneath it all are expectations, how people assess risk, and how the market works together. In the future, where oil prices go will depend on whether tensions calm down or get worse. If things stabilise, the market might settle and prices might stop moving so much. But if uncertainty continues or things get even more unstable, the risk premium could go up further. Higher oil prices have different effects around the world. Countries that sell oil and energy companies will likely do well, while countries that buy oil will face higher costs. For consumers, higher energy prices are a continuing financial strain. How energy prices and central bank policy interact is a key thing to consider. Central banks have to balance the risk of inflation with the need to help the economy grow, and energy costs are a major part of that. The current situation is one where the system isn't very flexible and expectations and political events directly affect prices. Oil is still very sensitive to changes in how risky things seem, and the recent price increases show that. The price increase after the negotiations failed shows how fragile things are. It shows that political events continue to affect how stable the market is and that expectations can change very quickly. What happens next will determine if this price change is just temporary or the start of a longer-term trend, and that will depend on how political conditions and expectations about supply evolve over time.